Hi, good evening everyone. I, Alisha, will along with my group members Hitesh, Ashwarya, Amrita and Tushar are here to present on the topic interest rates and how it affects businesses, which is a part of our course Managing Financial Resources. Now Tushar will be continuing.
Interest rates are the part of everyday business decision. A company pay interest rates when they borrow money. A company receives interest rates when they have enough cash. Company charge interest rates from the customers when they buy goods and services on credit. A rise or fall in interest rates affect the company's business decision in a longer way. Now Amrita will take the discussion.
I'll be talking about impact of high interest rates on businesses. Increasing when the interest rates are high, credit becomes expensive. It leads to economic slowdown. High interest rates may lead to inflation in the economy. It becomes difficult for the businesses to borrow loans from banks and expand the finance, manufacturing and operations. The flow of the cash reduces in the economy. The companies which function on fixed amount find it difficult to sustain in the stressful conditions. Now Ishwarya will take the discussion forward.
As being discussed by Amrita, that high interest rates help businesses not to have good profits, not to invest into new ventures. All these decisions may help them to have a good impact when we take decisions on low interest rates. Low interest rates have the advantage over high interest rates, like they help us business to invest into new ventures, to buy new equipments, machines, plants, so that they can expand their businesses. It also helps to gain the customer base by providing them good services and goods of good quality, because they have enough cash and profits so that they can invest into products and make a good quality product. All these activities help businesses to grow and expand, and also it helps businesses to spend rather than saving. This will impact on the minds of the customer, that business spending on their operations to help the customers and satisfy them.
Like interest rates matter both the companies and the customers. When in case of companies, when the interest rates are high, they are not able to procure the raw material, they are not able to spend on the promotional activities. Whether like in other case, when the interest rates are lowered, they are able to procure raw materials, invest more in branding and promotion activities. This leads to more production, everything gets higher. In case of customers, when they are given at loans at low rates, they're able to purchase more, the purchasing power increases, and this in turn affects the manufacturing companies who produce more cars, more electronic goods. In this way, it helps in increasing that everything. In other case, like in case of RBI, when they reduce the interest rates, they are promoting the infrastructural developments in the society, which helps customers to buy more loans, to buy more houses, which helps the other industries also, like the cement industry, like the furniture, the interior designing industries, and everything goes higher and higher. There are other types of demands, like in the market, when the seasons are coming, like Navratri or the wedding season, interest rates are lowered by the companies, even promotional discounts are given to promote more manufacturing activities. Now next to Alisha.
To conclude the discussion, I would like to ask, if you have ever taken a loan from a bank or from a lender, you would know you're not only responsible to repay the principal amount, but you also need to repay the interest. Now, what is an interest rate? Interest rate is nothing but the percentage of any percentage that is charged from the lender to the borrower on a principal amount. Now, talking about setting customer and business interest rates, which is done with the help of Federal Reserve. Federal reserves are done with the help of federal fund rates. Now, what are federal fund rates? They're nothing but one bank charges the other banks to borrow loans. When the buying exceeds the amount of cash in the economy, that time lenders charge high interest rates from people and businesses. Whereas when the circulation of cash in the market is higher than the demand, that time lenders charge low interest rates. As discussed by Ashwarya and Amrita previously, that how low interest rates and high interest rates affect business. High interest rates slow down the businesses because they cannot purchase or expand their businesses, whereas low interest rates help businesses expand because it's easier for them to purchase equipments. That's all. Thank you.